How many bank accounts should your nonprofit have? Well, there's no one size fits all answer to that question because it's going to vary depending on your situation. But I've got some pretty good guidelines that I think will apply to you no matter what your size. There are two goals related to setting up your bank accounts in a nonprofit. I really keep in mind these two things. Number one, we want to simplify the accounting and make it easy to see what's happening and what has happened. Number two, we want to do it in a way that we are protecting our resources. So here you go. There's no one size fits all approach, but this is my guideline, generally speaking. The first account you need is an expense account. Maybe call it your payables account. And it's where all the outgoes happen, or all the payments going out go here. So you fund that every week based on the payments that are scheduled to be paid that week. If you don't have a system for doing that, you need one. Let's talk. Number two, your payroll account. So this is where you're going to pay out all of your payroll checks or direct deposits and the related payroll taxes. The reason I recommend a separate account for payroll is it allows for confidentiality of your payroll data. It's separated from those other expenses that may or may not be managed by another staff member. And also it allows for a really transparent review of the largest expense going out of your organization. What I mean by that is, yes, I do strongly recommend that a bank, that the person performing the accounting is not the same person reconciling the accounting records. So that second person that's doing the review would be able to see a lot more about the trends that could create some really clear questions and just good accountability here. Okay, the third account is your deposit account. And that is literally what it sounds like. All money being deposited, all of the revenue goes into this account. Again, allows for a reviewer to see trends and notice any significant changes. Now, all of the money that's coming into the deposit account can then be strategized because we, in step 1 and 2, the first two accounts, we're pulling money out. So we know what we need to fund for payroll. We know what the expenses are for the week and for the month. That being said, then all the money that's left in the deposit account has opportunity to be invested. And depending on your banking relationships, lots of banks offer really good products. There's something called an ICS. There's CDAR accounts, CDARS, related to CDs, and a lot of other sweep repo type arrangements. Just depends on your banking relationship, what they may be able to offer you. So this is where you want to bring them to the table to have this conversation. Now, I need to point out that this blog doesn't address credit risk matters, which are very significant. And this is often what we think of when we think of FDIC insurance. And that insurance is $250,000 per entity or EIN number per bank, not per bank account, but per entity. So you'll want to keep that in mind. And if you have over $250,000 that you're managing a balance of, then you're going to need to assess those risks. And I would really encourage you to maybe have an investment policy to address this. Well, I hope that's really helpful, a good guide. If you are starting from a place where you only have one bank account, then you're going to need to start thinking about how to break those off one piece at a time. I would recommend that you get started soon. If you need some help, jump on my website. I'd love to do a consult with you. Please feel free to book a consult there. I'm available, and I hope you have a CFO-minded strategist in your pocket. But if you don't, then I'm here if you need me.